Between 2021 and 2025, an Indian corporation reported revenues of approximately $158 billion. That number exceeds the economic output of dozens of countries. The company claiming this scale was Rajesh Exports. Starting as a modest jewelry trading business in 1989, it grew to claim it processed roughly 35% of all the gold produced worldwide. The jewel in this empire was secured in 2015. Rajesh Exports acquired Valcambi, a highly prestigious Swiss gold refinery, in a landmark all-cash deal. Owning a world-renowned European refinery gave the parent company an aura of absolute legitimacy. It presented an integrated global supply chain so vast and reported revenues so large that the numbers appeared immune to basic scrutiny. In March 2024, a shareholder filed a routine complaint. They noticed that large trade receivables had been sitting unpaid on the company's books for more than 2 years. That single discrepancy prompted India's market regulator, SEBI, to pull a loose thread. They launched an investigation and appointed forensic auditors to examine the books. After examining the records, SEBI issued a 109-page interim order. Investigators reported that they could not independently verify the vast majority of the company's financial reporting. According to the regulator's preliminary findings, 99.8% of the company's consolidated revenue across 5 financial years was a prima facie misrepresentation. The immense scale of the reported gold empire was the exact mechanism hiding an almost entirely empty core. To understand how $158 billion materializes on paper, we have to look at how the company structured its operations across international borders. The corporate architecture started with the listed parent company in India, which owned REL Singapore. That entity owned Global Gold Refineries, or GGR, in Switzerland, which served as the holding company for the actual operating refinery, Valcambi SA. Under Swiss law, the operating unit, Valcambi, is audited by KPMG. During the investigated period, those audited standalone financials reported actual revenues ranging from just 400 to 700 crore rupees annually. However, the intermediate holding company right above it, GGR, is exempt from independent statutory audits under Swiss law. It was at this unaudited node where Rajesh Exports reported lakhs of crores in revenue. By parking the bulk of its reported turnover in a jurisdictionally exempt holding company, the corporate structure bypassed the audited books of its own operating refinery, fabricating trillions of rupees out of sight. When the financial statements are stress-tested against basic accounting principles, the math breaks down entirely. This chart shows the company's performance for the 2025 financial year. The massive column represents 4.23 lakh crore rupees in reported consolidated revenue. The nearly invisible sliver at the bottom is the profit after tax, just 95 crore rupees. That calculates to a net profit margin of 0.014%. A multinational enterprise moving trillions of rupees in transaction volume cannot survive on a near-zero margin. The severe disconnect between top-line revenue and bottom-line reality signals an extensive balance sheet padding exercise. The anomalies weren't restricted to Switzerland. The standalone Indian operations revealed a similar pattern. Between 2022 and 2024, the Indian parent company recorded about 11,487 crore rupees in sales and an almost identical 11,488 crore rupees in purchases, with a single domestic broker named Affluence Shares and Stocks. But when SEBI questioned Affluence Shares and Stocks, the broker categorically denied having Rajesh Exports as a corporate client. They stated they only dealt with the company's founder in his personal capacity. As investigators dug deeper into these trades, they repeatedly asked the company's management for primary ledgers, journal dumps, and vendor invoices. The company refused to provide them. A publicly traded empire, ostensibly one of the largest by revenue in India, operated a total blackout. They claimed trillions in turnover, but could not produce verifiable transaction data for the regulators. The company wasn't guarding proprietary information. The lack of ledgers, combined with the perfectly symmetrical broker trades, points to a lack of genuine economic activity within the domestic business. The mechanisms found in the Rajesh Exports investigation expose a recurring vulnerability within the Indian corporate landscape. In 2009, leadership at Satyam Computer Services confessed to inflating their financial statements. They used a complex web of transactions to create over 5,000 crore rupees in fictitious cash and bank balances to satisfy investors. Both cases relied on a maze of intercompany accounts and offshore blind spots to artificially inflate revenue figures, while the statutory auditors signed off on the results. The market's inability to detect the illusion early on shows that the structural flaws responsible for past financial catastrophes remain active today. An alleged $158 billion misrepresentation cannot happen in a vacuum. It requires a failure at multiple levels of financial oversight. Auditors continually validated financial statements anchored by unaudited offshore holding accounts. Simultaneously, major institutions like Canara Bank maintained large financial exposures to the company based on those exact filings. SEBI has now barred the company's leadership from the securities market and referred the case to the National Financial Reporting Authority to aggressively probe the statutory auditors. Padding a balance sheet to this extreme serves a specific function. Creating a trillion-rupee accounting illusion provides the necessary cover to help legitimize massive, untraceable flows of global capital. If a company can claim a trillion-rupee turnover with an empty domestic shell and an unaudited Swiss proxy, it forces a reevaluation of what other phantoms are currently propping up the market's reality.